Welcome to the Swing Trading with Cycles channel. It's November 11th. We're going to look at the gold to SPX ratio today. I got this idea from Northstar on Twitter, at Northstar. Twitter, check them out, at Northstar. There's also Northstar Bad Charts, the YouTube channel. I think they also have some kind of paid service. You can definitely check them out. I'll put a link in the description to that channel. This is a different view of that same sort of chart, but looking at it the unique way we do on this channel, looking at that big picture, focusing on price action. We're going to spend a lot of time on the annual chart. And the exciting thing about this is that we have over 100 years of data to play with, because this is data going back to before the the crash in 29, right? And so that's really exciting. So let me pull that up. So the way that you access that is you do XAUUSD and then divided by SPX. I use the one that's provided, like the data provided by TVC, and then you just hit enter, and then now we've got it. Okay, so this is our usual setup: daily, weekly, monthly, and here this is the annual. We're going to zoom in on the annual. I'll take off the crosshairs. I mean, look at this chart. This thing, the first data point here is from 1905. So this has the panic of 1907 in it, right? Like this panic. This is the panic of 1907 because gold massively outperformed the S&P that year. So again, to recap, and for those who are not familiar, please take a look at the link in the description for Cycles 101. Just kind of understanding price action in general as well. These charts are epic because it's an entire year of price action in every single candle. So it's a way to reduce noise, and the big trends kind of stick out to you. So the first thing that I'll do is I will label the major swing highs and swing lows. We'll start with swing highs. And to recap, a swing high is the way a downtrend starts, right? It's when price makes a new high and then the subsequent candle or subsequent candles go below the low of the candle that marked the high. So let's mark the major ones. The biggest one, it should jump out to you like a sore thumb. That right there, right? I hope that's obvious. I mean, you can see it. Where does the swing high happen? It's very clear, right? Below here, right? Like as I just said, candle makes a high, and then the subsequent candles go below the low of that candle, making that candle a swing low, a swing high, and starting a downtrend. And we're going to trend this as well. Very fun stuff. Again, we're talking about over 100 years of data here. Very exciting. So that's your first swing high that jumps out to you, and I'll just label the other ones. I'll go quickly here. That's another one. That's another one. That's another one. That's another one. Didn't last too long. And of course, there's a ton of, there are other ones here as well. We're not going to mark literally every single one. This is just to kind of give you an example. And now let's mark some major swing lows. So swing low is exactly the opposite of a swing high. So it's bullish. It's when a candle makes a new low and then the subsequent candles make a high, right? So it's a bottoming pattern. I'm drawing I put this one on here very speculatively, and we'll talk about what that could mean. So again, to reiterate, here's another one. Actually, this is an important one. To reiterate, every candle here is an entire year of price action. This is the year 1905. This is the year that we're in right now, which is green so far, year 2022, excuse me. Okay, so you can see the major swing highs and swing lows. And so what should be clear to you is that as of right now, we are in a downtrend. How do we know that? Well, is this a high? Yes. Is it a high that's lower than this high? Well, yes, right? So we have lower highs. Now, we don't have a lower low below this low, which was set in 2000. So that was from... that was when the last major sort of gold bull run started. So you would actually need a move below there to continue this really long-term downtrend. But right now, this isn't promising because this is a high. And this is actually, I should have marked that. That's another swing high that is somewhat significant, right? And when we trend this, when we look at the trend in detail, you'll see why that's important, why each swing high is important. So we are in a downtrend, but it's also the case that we're green for this year. And that's important. There have been a lot of years where we weren't green. I mean, look at all these years, no green. Okay, so let's look at the trend for this, right? How would you trend this? So you had I'll call this like, and this is broad strokes here, folks. Obviously, this is slanting higher, but it's basically consolidation, right? Didn't really go anywhere for, 1, 2, 3, 10, 15 years. And then we had this move lower, right? Very clear we're going lower, right? Then we had this bounce higher. Then we had this move lower. And I'm not going to draw every single little squiggle. That's a move higher, which is basically a double top. Move lower, lower high, move lower, lower high, right? These are bounces. These are lower highs. Lower low, lower high. So that's a lower low, lower high. Lower low, lower high. That's actually not a lower low, so this is actually a period of consolidation. We'll just draw it like that. This made a slight higher high, not quite a lower low. But look at this, massive higher high. And then what is this? This is a higher low, so we start a little uptrend here. And we'll go circle back to all this. And another higher high. And then we make a low, but it's a higher low still. But then we do this, which is a lower high. So that's not good. And we'll come back and review all of this in detail, right? Boop, 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 boop. This gets a little tricky. That, and then that takes us to here, where we stand today. So, like, we're talking broad strokes here, folks. So a lot of consolidation here between, let's say, 1905 to like 1920, and then you have the Roaring 20s when the S&P did really well. Gold performed really poorly against it. Like, that makes sense. It's an inverse, right? And then you had the crash of 29 and that bear market for the S&P. Gold did really well. So we moved up. We moved above this cluster of highs, this consolidation. And then we kind of chopped for, like, we made a low, but much higher than this one. So this is a higher low. But then we didn't make a higher high. And I keep saying that because it's helpful to reduce things to that level of simplicity. An uptrend is higher highs and higher lows. You need both of those things, not just one. You can't just have higher highs. You need to have the higher lows too. And so in this case, we had a higher low, but we didn't get a higher high. We just got an equivalent high, basically, aka a double top. And then we made another low that wasn't higher or lower, equivalent low. Another way of thinking about that is this whole thing is just kind of chopped, right? We made a move lower, then we made a move higher, then we made a move lower. We really didn't go anywhere. But then we start a trending move, right? Because we make a little high here, but what kind of high is this? It's a lower high. Why? Because it's lower than these highs. And then we make a lower low. Now we're cooking with gas. This low is lower than these lows. So a downtrend has started. And again, remember, every candle here is a year. So we're talking about a downtrend that lasts for a few decades, right? And that's why I love these charts, because we're talking about what are things going to look like in, let's say, even 2030 right now. And obviously we're sitting here at the end of 2022. So we make this lower low here below these, and then we make a lower high, and then we make another lower low, this low lower than this one. Then we make another lower high, this high lower than that one. Then we make another lower low, another lower high, another lower low, another lower high. You see, like, basically from this period, let's call it 1949 down to like 1965, right? So a 16-year downtrend. Yikes. Like a definite, like, that's the beauty of this. It's just data, open, high, low, close. Are we making higher highs and higher lows, or are we making lower lows and lower highs? For this period, we were making lower lows and lower highs very clearly. And then we had this like rocket ship up, right? This is your move in the 70s. And then we make a higher low and then a higher high. We have that parabolic top in 1980, which we've never come back to, right? Everything since that has been below that parabolic top in 1980, a blow-off top, if you will. We come down, we make a low, but this is a higher low, higher than this one. So you think, like, if I were to like just put this like right here, like do this for instance, you might assume like, well, this is just a higher low than this, so we're going to resume higher and then make a higher high than this and continue the uptrend. Obviously, that's not what happened. We started another downtrend. Remember this 16-year downtrend? So now we started another downtrend. Once we came up here, poked our head up, and then collapsed, that started another downtrend. Lower low, lower high, lower low, lower high. And then we go really low into the basement. right? That happens in 1999. We hit that nadir, right? So you could say this downtrend started in 1988 and concluded in 1999. So 10 years of going lower. That sucks. And if you compare that to this like massive uptrend, that was 1, 2, 3, 4, 5, 6, 7, 8, 9. So 10 years of going higher. So that's not bad, right? Let's see. Are we going to have another period like that in the next 10, 15, 20 years? That's what we're going to see. And then we have this other little uptrend, right? So you have this uptrend and then this uptrend. So we make a higher high, higher low, higher high, higher low, higher high. Now, technically, and I'm going to get rid of these now so we can so we can see the candles. Technically, as long as we're above here, we actually haven't made a lower low yet, right? Because that was your last higher low. And so as long as you stay above this higher low, you're actually still potentially trending higher. So that's important, right? That's an important level to look out for to the downside. And just if we kind of pull into what's happening this year, we've had this since, what is this, 2011, right? That really ugly bear market for gold. Like we've just been kind of drooping lower. And then we had that 2020 move, right? Where gold rallied for like 4 or 5 months really hard. That created a really beautiful green candle in real time. But as we know, as we talk about all the time on this channel, candles transform, right? So at one point, this was a big, beautiful green candle. But then we pulled back really hard and we created this ugly shooter, which then had downside follow through in 2021. You can see we made a swing high, right? Once we went below the low of this candle here. And so to get back into a bullish mode, we need to get above this swing high. Like we need to get above this level here where this line is pointed, and then above the high from this swing high, which it looks like it's right at the 0.7 level. So at 0.7, and right here, right now we're at 0.443. So quite a ways to go, even to show that we're starting to make an uptrend again on the yearly chart, which means we're going to have to look at the smaller time frames, the lower time frames, to get a sense of the move. Otherwise, we'll potentially miss it. So, but that makes things really simple. Gold has been better than the S&P this year. We know that because it's green year, right? But at the same time, it's still just an inside year. That's the other thing to keep in mind, right? So all of that is just happening inside the range of last year, of 2021. So we need to break out of that range, which would incidentally get us above the low of this swing high. And then we can potentially challenge this level here. So that level is actually 0.694. So this is a nice, really simplified way of looking at all this. And not to make it even more complicated, but because this is such a long time frame, you could even imagine a world where we could consolidate these candles even further into decade candles, right? Because if we have 100 years of price action, theoretically, we could just have, 10 decade-sized candles, right? And you can almost kind of imagine that visually. If you clustered 10 candles like this, there wouldn't be much range on them, right? Like, just kind of think about it. I don't want to confuse folks, but like imagine something like that. So, like, imagine you took all these candles and you combine them with each other. That would give you, and you do that 10 at a time, right? That would give you essentially these decade-long candles. And what you would notice, like if you took these candles, for instance, pick a 10-year period and just kind of create a grouping. Notice that, and I hope you're seeing that, like if you imagine that this was just one candle, that is still inside the range of this big bull run off the 2000 low, right? So all that to say, we've not really been going anywhere. Now, we've obviously been drooping lower, but we're still well inside this range, which means there's time for us to resolve back up to the upside. And we're also putting in a green candle. Like we were just drooping. Another way to kind of interpret this is you could call this a bear flag, right? This is a bear flag of this down move. And we were starting to spill over as of 2021, and now we're fighting that. And so again, the battle that happens here, I'll zoom in, is going to tell us everything. We first need to get above this level down here. So what is that? 0.463. Then that puts us on a path to getting it outside this range from 2021. And then we can attack that 0.694 area and then up to here. And obviously this is a ratio chart. So you could see a world where both the S&P and gold are going up together, but gold is just outperforming. There are so many different ways that this could kind of play out. But this is a nice kind of simplified, remove the noise way to look at this. And if we wanted to just kind of hazard a guess at the sort of cycles, if we look at a monthly, you can see this thing has been in a long-term downtrend. Again, this is just your monthly chart. It's the same data, just looking at it a different way. And this teal line is the 50-month moving average. Notice we've basically lived below the 50-month moving average since 2013, right? We had that brief period in 2020 where we popped above it, where we had our little rally, and then we've since come down. And look at that. We've even kind of tested it from below. Now, this is great because it means either we're going to have a massive plunge lower, like that's what this is telling you, that either we're going to have a massive plunge lower, or we're about to break above it and kind of and with some force, because this is just consolidation beneath that range. Now, this was consolidation above it, which obviously failed lower, but the stakes are really high here, and this is just another kind of visual view of the tension, right? Something is going to break and like really kind of violently move, and we want to be ready for that, and we will be on this channel. So I'll definitely be watching this. Again, I know North Star tweets about this all the time. I'm going to start paying closer attention to this as well. I love the idea of this because this is kind of a bell ringing for a longer trending move that lasts many, many months. And as you know, those are exactly the kind of trades I like. So thanks for watching this sort of special installment. I hope you found this interesting to give you just some more context, especially if you've been seeing that data from North Star. This is a good alternative way to look at it. It's not saying anything necessarily different. It's more of a different perspective of how to kind of evaluate it and keep track of this thing as it keeps moving. So again, thanks for watching.